The 2.0% indexing hack. How much exactly is your Feb 2026 pension increasing? There's something happening right now with Canadian retirement income that most people aren't paying close enough attention to. February 2026. The numbers just changed. Your Canada Pension Plan payment adjusted. Your old age security recalculated. If you receive the Guaranteed Income Supplement, that shifted too. The government calls it indexation, a cost of living adjustment, a routine update. But here's what they're not emphasizing. The formula behind that adjustment, the timing of when it's measured, and the actual purchasing power it delivers, those details matter more than most Canadians realize. Because while your pension payment is going up by exactly 2.0% this month, inflation over the past year told a very different story. And the gap between what you're getting and what you actually need, that gap, is where your retirement security either holds steady or quietly erodes. My name is Joseph, and today we're breaking down the exact dollar impact of the February 2026 indexing increase, who benefits, who falls short, and why this annual recalculation has become one of the most critical and misunderstood mechanisms in the Canadian retirement system. Let's start with what most Canadians know. Every January, the federal government reviews inflation data and adjusts Canada Pension Plan benefits, old age security, and the Guaranteed Income Supplement to reflect changes in the cost of living. This process is called indexation, and it's been part of Canada's social safety net since the 1970s. The idea is simple. As prices rise, government benefits should rise too, so retirees don't lose purchasing power. But here's where it gets more complex. The indexation rate isn't based on what inflation was last month or even last quarter. It's calculated using the Consumer Price Index, the CPI, measured over a very specific 12-month period. For the February 2026 adjustment, the government used CPI data from October 2024 to September 2025. And that period matters, because inflation doesn't move in straight lines. It spikes. It cools. It accelerates in certain categories like food and housing, while slowing in others like electronics or fuel. The 12 months the government uses to calculate your pension increase may not reflect the 12 months you actually lived through at the grocery store, the pharmacy, or the gas pump. This year, the indexation rate came in at exactly 2.0%. Now, on the surface, that sounds reasonable. 2%, a modest increase, roughly in line with the Bank of Canada's inflation target. But pension policy experts have been raising concerns quietly for months, not about this specific number, but about the broader trend. Indexation formulas that lag behind real-world cost pressures, benefit structures that don't account for regional differences in living costs, and a growing number of Canadian seniors who are watching their fixed incomes lose ground year after year, despite these annual adjustments. Organizations like the Canadian Association of Retired Persons, the National Pensioners Federation, and independent economists have pointed out that CPI-based indexation often underweights the exact categories that hit retirees hardest: healthcare, prescription drugs, home maintenance, and property taxes. So when your CPP or OAS goes up by 2.0%, but your actual household expenses rose by 3.5% or 4% in those categories, you're not staying even. You're falling behind. And that's the quiet erosion we need to talk about. So let's get specific. As of February 2026, every Canadian receiving Canada Pension Plan retirement benefits, old age security, or the Guaranteed Income Supplement saw their monthly payment increase by exactly 2.0%. Here's what that looks like in real dollars. For CPP, the maximum monthly retirement benefit as of January 2026 was approximately $1,433.50. With the 2.0% increase, that maximum rises to about $1,462.37. That's an additional $28.87 per month, or roughly $346 per year. Now, most Canadians don't receive the maximum CPP. The average monthly CPP retirement pension sits closer to $850. A 2.0% increase on that amount works out to about $1,630 more per month, or just under $196 annually. For old age security, The maximum monthly payment for seniors aged 65 to 74 was approximately $718.33 in January 2026. The 2.0% indexing brings that to about $732.70, an increase of $14.37 per month, or roughly $172 per year. If you're 75 or older, you already receive a 10% OAS top-up, so your numbers start higher. The maximum for that age group was around $790.16, now rising to about $805.96, a monthly gain of $15.80, or about $190 annually. For low-income seniors receiving the Guaranteed Income Supplement on top of OAS, the increases vary based on income level and marital status. A single senior receiving the maximum GIS saw their combined OAS and GIS payment rise from approximately $1,118 to around $1,152, about $34 more per month. These are the official numbers, clean, precise, indexed to inflation. But here's the reality check. Rent in many Canadian cities didn't rise by 2.0% last year. It rose by 5%, 7%, sometimes more. Grocery inflation, while cooling from its peak, still ran higher than 2% for much of 2025. Property taxes in municipalities across Ontario, British Columbia, and Alberta increased at rates well above CPI. So, yes, your pension went up, but your actual cost of living may have outpaced it significantly. This affects approximately 7.3 million Canadians. Let's break that down. About 6.6 million Canadians receive old age security. Of those, roughly 2.4 million also receive the Guaranteed Income Supplement because their income falls below federal thresholds. Around 5.8 million receive Canada Pension Plan retirement benefits. But the impact isn't felt equally. High-income seniors who have substantial RRSP withdrawals, investment income, or workplace pensions may barely notice the indexing adjustment. It's a modest top-up on income streams they don't rely on for day-to-day expenses. For low-income seniors living primarily on OAS and GIS, this 2.0% increase is critical. It determines whether they can afford a medication, cover a utility bill, or maintain their housing. These are Canadians who spend nearly every dollar they receive. There's no buffer. Then there's the middle group, retirees with modest CPP, some RRSP savings, maybe a small workplace pension. They're not wealthy, but they're not eligible for GIS either. For them, the indexing rate determines whether their standard of living holds steady or whether they need to make small cuts, fewer dinners out, delayed home repairs, reduced travel. Near retirees in their late 50s and early 60s are watching this closely too. They're modeling their retirement income, trying to understand what CPP and OAS will actually provide when they stop working. And they're starting to realize that annual indexing, while helpful, may not be enough to maintain purchasing power over a 20 or 30-year retirement if inflation remains elevated or if healthcare costs continue rising faster than CPI. Fixed-income households, especially those with one pension earner supporting a spouse or dependent, feel these adjustments acutely. Every percentage point matters when there's no other income source to fall back on. Let's talk about what this really means for household budgets. If you're receiving the average CPP of $815 and the average OAS of $718, your total monthly government retirement income before the February adjustment was about $1,533. After the 2.0% increase, it's approximately $1,564. That's an extra $31 per month. $31. Over a year, that's $372. Now, let's compare that to real-world cost increases. If your monthly grocery bill was $400 and food inflation ran at 3% over the measurement period, your groceries now cost about $412 per month. That's an extra $144 per year. If you're renting and your landlord raised rent by 4%, well within legal limits in many provinces, on a $1,200 apartment, you're now paying $1,248. That's an additional $576 annually. Utilities, home insurance, property taxes. Let's say those combined rose by an average of 3.5%, adding another $200 to your annual expenses. Added up, $144 for groceries, $576 for rent, $200 for utilities and insurance. That's $920 in additional annual costs. Your pension indexing gave you $372. You're short by $548. And this is a conservative scenario. Many Canadian seniors, especially in urban centers, are facing cost increases well above these estimates. This is the erosion I mentioned earlier. It's not dramatic. It's not a sudden crisis. But year after year, if indexing lags behind actual cost pressures, retirees lose ground. Their retirement savings get drawn down faster than planned. Their discretionary spending disappears. And eventually, some face difficult choices about housing, health care, or basic necessities. So why does this gap exist? The federal government would argue that CPI-based indexation is objective, transparent, and sustainable. It's tied to a widely recognized measure of inflation that captures price changes across the entire economy. It prevents political manipulation of benefit levels, and it provides predictability for fiscal planning. All of that is true. But there's another reality at play. Canada's population is aging rapidly. The number of seniors is expected to reach nearly 10 million by 2030. Every percentage point added to pension indexing costs the federal government billions of dollars. With deficits running high, debt servicing costs rising, and pressure to fund healthcare, infrastructure, and climate initiatives, there's limited fiscal room to increase pension spending beyond what the formula dictates. Some policy analysts suggest that the government is effectively managing pension costs by sticking rigidly to CPI indexation, even when it's clear that seniors face above-average inflation in key spending categories. It's not a cut, it's not a freeze, but it's also not full protection. There have been calls from advocacy groups to adjust the indexing formula to better reflect senior-specific costs. A seniors CPI that weights healthcare, housing, and food more heavily, or regional adjustments that account for cost of living differences between Toronto and rural Saskatchewan. So far, Ottawa has resisted those changes. The argument against them is complexity and cost. A senior-specific CPI would require new data collection, new formulas, and almost certainly higher payouts. Regional adjustments would create political challenges and administrative burdens. But the argument for them is fairness and accuracy. If the goal of indexation is to preserve purchasing power, then the formula should reflect the actual inflation retirees experience, not a generalized average that includes younger working households, buying cars, and electronics. This tension isn't going away. As more Canadians retire, and as cost pressures continue, expect this debate to intensify. Pension experts and advocacy organizations have been vocal about these issues, though their concerns haven't always broken through into mainstream coverage. The National Pensioners Federation has repeatedly called for a review of how pension indexation is calculated, arguing that current methods systematically undercompensate seniors for real cost increases. Independent economists have pointed out that while CPI captures broad inflation trends, it doesn't fully account for substitution effects or quality adjustments that may not apply to seniors. A younger household might switch to a cheaper brand or delay a purchase when prices rise. A senior on medication or with mobility limitations often can't make those substitutions. Provincial advocacy groups, particularly in high-cost regions like British Columbia and Ontario, have highlighted the disconnect between federal indexing rates and local housing inflation. A 2.0% OAS increase doesn't go far when your property taxes and maintenance costs are climbing by 5% or more annually. Public response has been quieter, but it's there. Online forums for Canadian retirees show growing frustration. People are sharing budgets, comparing notes on how far their pensions actually stretch, and expressing concern about long-term sustainability. Some seniors are returning to part-time work, not by choice, but out of necessity. Others are downsizing earlier than planned or relocating to cheaper regions. This isn't a crisis making headlines, But it's a slow-moving challenge that's reshaping retirement security for millions of Canadians. So what should you be doing right now? First, understand your exact benefit amounts. Log into your MyService Canada account and review your CPP and OAS statements. Know what you're receiving, when your payments are indexed, and how much you can expect. Second, track your actual expenses. Not what you think you're spending, but what you're really spending. Compare that to last year. If your costs are rising faster than 2%, you need to adjust your retirement plan accordingly. Third, review your withdrawal strategy if you have RRSPs or TFSAs. If government benefits aren't keeping pace with inflation, you may need to draw more from savings than you anticipated. That has tax implications and longevity implications. Work with a financial planner if necessary. Fourth, consider your housing situation. If you're spending more than 30% of your income on housing, that's a warning sign. Explore whether downsizing, relocating, or accessing home equity makes sense for your situation. Fifth, stay informed about policy changes. Federal budgets, CPI reports, and pension policy announcements matter. Small changes to eligibility rules, clawback thresholds, or indexing formulas can have significant impacts on your retirement income. Sixth, advocate. If you believe the current indexing system doesn't adequately reflect senior costs, let your MP know. Join advocacy organizations. Participate in consultations. Policy change happens when enough people make the case for it. And finally, avoid panic. Yes, there are challenges. Yes, indexing may not fully protect purchasing power. But Canada's public pension system remains one of the strongest in the world. The key is planning realistically, adjusting as needed, and staying ahead of changes rather than reacting after the fact. Looking ahead, several factors will shape how pension indexing evolves. Inflation trends matter. If inflation stays close to the Bank of Canada's 2% target, future indexing rates will likely remain modest. But if inflation remains elevated or volatile, pressure will build for formula changes. Demographics matter. As the senior population grows, their political influence grows too. Governments will face increasing pressure to address retirement income adequacy, whether through indexing changes, benefit increases, or new programs. Fiscal capacity matters. If economic growth slows or if debt servicing costs continue rising, Ottawa's ability to enhance pension benefits will be constrained. That could mean continued reliance on CPI-based indexing, even if it's imperfect. Provincial actions matter. Some provinces have introduced their own senior benefit top-ups or property tax relief programs. If those expand, they could partially offset gaps in federal indexing, and public awareness matters. The more Canadians understand how indexing works and where it falls short, the more likely we'll see meaningful policy discussion and potential reform. One scenario is status quo. CPI-based indexing continues as is, with incremental adjustments that keep pace with general inflation, but not necessarily senior-specific costs. Another scenario is reform, a new indexing formula that better reflects retiree expenses, possibly phased in over several years to manage costs. A third scenario is enhancement, direct benefit increases, particularly for low-income seniors, funded through general revenues rather than formula changes. Which path we take will depend on political will, fiscal reality, and sustained advocacy. Here's what you need to remember. Your Canada Pension Plan, Old Age Security, and Guaranteed Income Supplement just increased by 2.0% in February 2026. For some, that's meaningful relief. For others, it's barely keeping pace. And for many, it's falling short of real cost pressures. This isn't about fear. It's about awareness. Understanding how indexation works, what it covers, and what it doesn't, that knowledge is power. It allows you to plan better, adjust smarter, and advocate more effectively. Canadian retirement security depends on informed citizens who ask the right questions, challenge assumptions when necessary, and hold policymakers accountable for ensuring our social safety net actually works. So stay informed, track your benefits, monitor policy changes, and don't assume that automatic indexing guarantees a stable retirement. It helps, but it's not the complete solution. If you found this analysis useful, please subscribe to this channel. We'll continue tracking pension policy, government benefit changes, and retirement planning strategies that matter to Canadian seniors and near retirees. Share this video with family members, friends, or anyone navigating retirement income planning. And leave a comment below. Are you seeing the 2.0% increase reflected in your payments? Are your costs rising faster than indexing? What concerns do you have about long-term retirement security? This is Joseph. Stay informed, stay prepared, and I'll see you in the next video.